So you're sitting on a huge mountain of cash. It's just sitting in your checking account doing absolutely nothing. You don't need this money for 10 years, but the stock market just looks so high. Why not just wait for a pullback and then you can invest all that money at a lower price? So you wait and wait and wait. 3 months later, the stock market has still been going up. So now what do you do? Just like any sensible person would do, you get on YouTube and start watching videos. While watching your YouTube videos, you stumble across a fine strategy called dollar cost averaging. The idea of dollar cost averaging is simply that if the stock market is going like this over time, rather than investing all of your money in at one time and then potentially risking the market going down, instead, you just invest a little bit each month over the next 3, 6, even 12 months. And so if prices go lower, you'll be buying as the market goes down. And if the market completely crashes, you won't have all of your money invested. Genius, right? It does seem like a very smart strategy, and it's very widely recommended by a lot of financial professionals. And yet, what does the evidence actually suggest? In this video, we're going to take a look at what the data actually says. We're going to look at an academic study from 1993. Then I'm going to show you my own study. Which of these 4 strategies is going to come out on top? Let's find out.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
In 1993, a couple of researchers decided to test the common wisdom that you should dollar cost average instead of invest a lump sum. So they did not 3 strategies, but 4 strategies using data from 1926 to 1991. The 4 strategies were, first of all, investing all in the S&P right away. The second was investing over 3 months. The third strategy was investing over 6 months. And the final strategy was investing over 12 months. In each of these studies, they used T-bills as the assumed rate of return you were getting while sitting in cash. And their results were pretty surprising. They found that the lump sum investment, meaning you invested it all at the beginning, outperformed in 60% plus of their 780 observations. And these observations were over a rolling 12-month time period. So the average return of these 780 doing a lump sum was 12.75. 3-month dollar cost averaging was 11.1. 6 months was 10, and 12 months was 8.5. And they also found that these results were statistically significant at the 95% level. And in plain English, that just means that this is very unlikely to be a fluke. In the study, they say that these results strongly support a lump sum investment strategy over a dollar cost averaging strategy. I wanted to test those conclusions and just see if we did a bigger data set, what would change about the results. So my study looks at Robert Shiller's data going back to 1871. I'm going to do the same 4 different strategies, but I'm going to hold it for 10 years rather than just 1 year, since most of the time when you're investing in stocks, you should be doing it with a longer term mindset, not just looking at the next 12 months. Let's start with the worst performing strategy, which was the 12-month dollar cost average. So going back to 1871, looking at every single rolling 10-year period starting each month, the lump sum would have been larger in over 70% of observations. Dollar cost averaging would have been better in 30% of those observations. For example, dollar cost averaging during the Great Depression basically would have been a good idea since the stock market did terribly over that time period. If you would have dollar cost averaged over 12 months, then you would have outperformed a lump sum strategy by 5.9%. However, you can see that the average performance was significantly lower than the average performance in the lump sum strategy. The average growth of 100,000 grew to 254,794. That is a roughly $10,000 less than the lump sum strategy produced on average. The best performance of the lump sum strategy was over $64,000 larger. And even the worst performance ended up being better for the lump sum strategy. A $100,000 investment made in July of 1929, right before the Great Depression, would have shrunk to $66,267 by July 1939. Meanwhile, the worst performing 12-month dollar cost average strategy would have shrunk from $100,000 to $65,906, and that would be from February 1999 through February of 2009. And basically, in this market, you would have started your dollar cost average right near the top of the tech bubble. So you'd be putting money in each month here, and then right as soon as you got fully invested, the market completely collapsed. So clearly, investing over a 12-month time period does not protect you in the slightest. If those 12 months are all in a bull market, you're going to be buying higher and higher and higher. And then right as soon as you're fully invested, the market could fall. The third best performing strategy was dollar cost averaging over 6 months. It outperformed the lump sum in 33% of these observations. The biggest outperformance was 3.2%. And again, we see the average performance and best performance was lower than just investing it all at the start. It did have slightly better worst performance. The 6-month dollar cost average right before the Great Depression would have shrunk 100,000 to just under 67,000. Meanwhile, the lump sum right before the Great Depression would have turned 100,000 to 66,267. So a slight edge there in the worst historical observation. The number 2 strategy was the 3-month dollar cost average. You can see the theme here. Dollar cost averaging over a 3-month period outperformed the lump sum in 36.5% of observations, with the biggest outperformance of 2.5%. The average was just over $2,000 less than the lump sum. The best performance was a little bit over $20,000 worse. And again, we see a very slight improvement in the worst case performance, again, during the Great Depression. So it's no surprise then that the lump sum strategy was the number 1 performing of these 4. It outperformed the dollar cost averaging in between 63 and 70% of the observations. It also earned higher average returns across the board, and it's also backed by academic research. It's also backed by logic. If the long-term returns of stocks are typically up, that means that every day that you wait without investing is more likely to result in a higher stock price. Obviously, that doesn't always hold, but over time, the probability that stocks go up is higher than them going down. So it's naturally going to be a losing situation to sit around and wait to get invested. Of course, the market could completely fall apart starting tomorrow, but unless you can time the market perfectly, which no one to this point has been able to do, the historical data would suggest the best thing you can do is just continue to invest as soon as you possibly can, as long as your time horizon is at least 10 or more years. But there's one important thing I want to say if you're watching this video and thinking, yeah, but I just can't get myself to invest this giant lump sum of money all into the market at one time. Just know that it is better for you to do something like dollar cost averaging. If that's going to encourage you to get money to work, make smart financial decisions, then by all means do that. It may be kind of illogical and the data does not back up that particular strategy, but it is a reasonable thing to do. And in the end, if your time horizon is long enough, it's probably not going to make that big of a difference in the end anyways. Even if you're the worst investor on the face of the earth, you can still have a very good investment result if you're patient and consistent in your saving. If you want to know more about that, check out my next video where I'll show you how the worst possible investment strategy compared to the best possible investment strategy, and the difference may surprise you.